This is Tax Chats. Hello, I'm Scott Dyring.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello, everybody, and welcome again to Tax Chats. I'm Scott Dyring, and it's great to be with you today. I'm joined once again by my friend and colleague, Jeff Hoops. Hello, Jeff.
Hello.
Today, we're going to talk to you about an amazing event that occurred, which was Satya Nadella, CEO of Microsoft, selling half of his shares in Microsoft a few weeks ago. Many people believe to avoid paying a new capital gains tax that will become effective in the state of Washington very soon. Jeff, do you think that's why he sold?
I mean, I think he likely sold mostly to get money, but I mean, taxes might have been on his mind.
Of course they were on his mind. All of us tax people always have taxes on our mind.
So, yeah, actually, to be clear, like if his goal was to minimize taxes, he would just never sell, which we'll talk about a little bit. But he's probably thinking, oh, okay, I need some cash, or there's other considerations. I'm sure it wasn't only about taxes, but did taxes play a role? Probably.
Of course they did. We have to say that.
Yeah.
Okay, so let me give you just a little bit of background. There's not a ton of detail, but when a major shareholder sells stock, the company has to, there's a filing that's required. And so you can go to public filings at the Securities and Exchange Commission website, and one can determine how many shares of stock Mr. Nadella sold. So he sold 840,000 shares of Microsoft, and the proceeds were $285 million. So it's something like $340 a share. And in Washington, a recently enacted but not quite yet effective capital gains tax rate is forthcoming, which would place an additional state-level capital gains tax of 7% on long-term capital gains. And so by selling, if Mr. Nadella sold $285 million worth of shares, and his basis, which is the amount he paid for those shares, were zero, which it probably isn't, but just suppose it were zero, that would mean he would have long-term capital gains of $285 million. He would have to pay tax at 7% to Washington, in addition to the federal tax, which for him would be probably somewhere in the neighborhood of 25%.
Now, is that 7% an increase in Washington, or is that the total tax?
I think that's the total tax.
So that's quite a bit extra. So why don't we know his basis? You just said we're going to assume zero. Why don't we just see from the SEC filing what his basis is?
The SEC filing does not require a disclosure of the basis. It only requires a disclosure of the number of shares sold and the price at which those shares were sold. And he sold them in different batches. It's really hard to sell 840,000 shares all at once. So he sold them in different batches, and you can go to the filing, which I did, and you can look at it and you can see, what the price is per batch, but you cannot see what his basis is. So,
and the reason, of course, is because turns out the filing isn't meant for people on podcasts to be able to infer his tax liability if he was responding to taxes, but rather people who think that, the bigger reason is people who think that insiders trading provides some market signal, in which case it doesn't matter what their basis is. It just matters that they're selling and how much and when.
That's right. So for our amazing tax purposes, let's assume that he got all of those shares for free, which is almost certainly not true, but let's just assume that. The amount of tax that he would have potentially saved if he got all the shares for free would have been about $20 million by selling the shares now so that he doesn't have to pay the 7% tax in the state of Washington. $20 million is a pretty big number.
Is it even big for him?
Okay. That's an interesting question. I was at a car dealer buying a car the other day, and the guy said something to me like, look, you can just do this thing. It's only $1,000 more, and you're paying $50,000 for this car. What's one more $1,000? And I said, I can do a lot of things with $1,000. So yes, $1,000 is a lot more.
You could buy half of my car for $1,000. That's one thing that's one thing you could do with $1,000.
I could probably buy 2 of your cars for $1,000.
Oh, no. COVID has brought the price of this thing up. It's now worth at least $2,000.
For those of you who don't know, Jeff Hoops, who is fairly large in stature, drives a Toyota Yaris. And when he wants to stick his arm out the window, he has to roll down the back window because his seat is so far back.
Not true. That is
too true.
That's not true at all. In any event, so like whether this $20 million was material to Mr. Nadella is,
it's debatable.
It's debatable, but it's also not necessarily the case that it has to be like material in some economic sense. Like psychologically, it's money. You don't want to just give it away to some entity you don't necessarily want to have it. If you could take steps that are pretty easy and costless to avoid having that outflow, you do it.
Yeah, exactly. And so 20 million is big. Now, I know some technical tax people out there might be saying, well, we know that his basis wasn't 0. So we could say, suppose his basis was whatever Microsoft's stock price was 5 years ago when the shares were given to him. And let's suppose he was given the shares 5 years ago. At that point, Microsoft shares were worth something like $65. They've gone up to $340. So they've increased in price dramatically.
That's been a good 5 years. That's pretty amazing, actually.
It really is an amazing 5 years. But if he had that basis, the amount that he would need to pay, the amount that he's saving by making this sale would be something like 16 million, not 20 million. But it's still like many more millions than I will ever have to my name.
Even with the turkey farm treasures.
Even with the turkey farm inheritance. Yes, that is true. So yeah, you raised an interesting question. Was this like the smart tax thing to do? Or could he have done better? That's an interesting question to ask. So I'll ask you, could he have done better?
Well, so I think the question we already talked about is whether or not this is all tax motivated. I mean, who knows what he was actually thinking in the back of his mind, but let's assume it was. Let's assume his goal really was to save as much in taxes as possible. And it really all matters what the alternative was, right? So if the alternative was to sell in a year, then yeah, this is a pretty good move, right? We know that Washington capital gains tax rate is going to increase, and assuming he would still be a resident in Washington in a year, and assuming it really is going to increase, then selling today is a great idea. But if the alternative is, for example, to hold for 15 more years, it might not have actually been a good idea. So even if the tax rate is high in 15 years, it actually gets to be a little bit complicated. And here's why. Essentially, if he sells now, he will still owe some taxes today at the low rate. If he doesn't sell for 15 years, he can essentially save the taxes that he would pay now at the low rate, invest it and keep it invested in Microsoft. It'll keep on growing for 15 years. And that growth might be more than the taxes he saved by selling at the low rate rather than the high rate.
So we can put some numbers very kind of back of the envelope to that. If he has to pay 20 million in tax on 285 million in proceeds, if instead, which nets him 265, if instead he left all 285 in the stock, let it grow for 10 or 15 more years, the total net after-tax proceeds might be higher.
I mean, actually, it depends on their return. It is entirely dependent on their return. And if the return over the next 20 years for Microsoft is equal to the return you just talked about over the last 5 years, it's crazy, not even a question whether it'll be higher to just defer taxes.
He would have been better off.
He's way better off.
Which is a general principle that one could really apply, which is in most cases, it's better to pay later than to pay now.
It's all dependent on their rate of return. But yeah, so like the ultimate capital gains tax saving strategy is just not to have a capital gain, right? So the basis of the capital gains tax is if you sell your shares, you have to pay capital gains tax. It's pretty easy to not pay capital gains taxes, of course, just by not selling your shares. And there's like the ultimate in this is, of course, just to never sell your shares and wait until you're dead, because in the United States currently, and for the last long time, we have what's called the step up in basis at death, which means if Mr. Nadella, for example, would have held these shares until he died, no matter what their basis was, or what the market value of those shares was when he died, his heirs, whoever got these assets after he died would have inherited them and not had to pay any capital gains taxes at all.
Correct. At his death,
which is pretty crazy, right? This would have been hundreds of millions, if he dies in 20 or 30 years, would have been probably hundreds of millions of dollars of saved capital gains tax liability, which is a big deal.
Okay, so we've talked then about a couple of ways one can manage to pay less in capital gains. One is to pay later, defer. Another is to die.
Until you die. Well, so to defer until you die.
Well, okay, so hang on. One method, just deferring over 15 years, could save you tax, but it might not eliminate the tax.
Correct.
The second is defer all the way until you die, in which case you just eliminate the tax. It's not kicking the can down the road. It would just be eliminating the tax, which might be even better.
And of course, the first way that we talked about is if you see a statutory tax rate increase, you could sell now. If you see a statutory tax rate decrease coming along, you wait until the decrease to sell. And all of that's, of course, relative to when you would have sold otherwise. But of course, when we talk about the ultimate planning strategy is just to defer, not sell, there's a big downside to that, actually. If it's just not sell for 15 years, it means, for most people at least, you really don't have access to that cash for 15 years. And if you need that cash to do something else, it's a pretty big downside. Of course, there's an even bigger downside to waiting until you sell, or not selling until you die, essentially, just waiting until death. And the downside, of course, is
you're dead.
You're dead. Yeah.
Dead.
Like as a doornail.
Hard to enjoy your cash when you're dead. So there is that.
Actually, I don't know. I've never been dead. It might be easier. Who knows?
Maybe
it'll go to your, Scott has a lot of kids. He's never disclosed this, but he's got, 30 or 40 kids. If that cash all goes to his children, maybe it'll be even easier. You can be floating around, watching all these kids spend money like drunken sailors. It'll be even easier to enjoy that cash once he's dead.
It might be.
I guess we'll leave questions for the afterlife away from this. Let's assume it's hard to enjoy the cash.
We'll defer those questions until we're dead.
Defer those questions, yes.
Okay, good. So there are obviously other ways that one might think about reducing the tax burden on capital gains. Can you think of any others?
So we talked a couple weeks ago about stock options and Elon Musk, and one thing that came in a little tiny bit in that episode is Elon Musk moved from California to Texas. And it was a little tricky with the stock options. Like California would be able to get some of that stock option tax revenue, even though he's in Texas when he exercised the options. But for capital gains, for the most part, if you just hold stock, you just pay where you live. So one way would be to simply move to a state without a capital gains tax before you realize your capital gains.
So let's think of some popular destinations. Florida, no personal income tax. Is that correct?
Yes, of course. Then you have to deal with the alligators and sinkholes and.
So that might not be ideal, because if you're cruising around in your golf cart when you're retired and you accidentally fall out near a pond, you may never.
Or into a sinkhole. Or into an alligator-infested sinkhole. Even worse, the double whammy.
Okay, but there are the pleasant winters.
Yes.
So that's an advantage. That makes Florida a much more desirable retirement location than, for example, California, where the tax rate is exceedingly high.
Yes, but also have pleasant winters.
Okay, so is Florida the only... I guess there's Texas.
There's a handful of states without a capital gains tax. For example, Wyoming also has very pleasant winters.
I once went snowmobiling in Wyoming near New Year's, and it was 15 below zero. It was not what I would call pleasant temperature.
Depends on what you define as pleasant.
My eyelashes freezing to my eyeballs may not be pleasant for most people.
How would that snowmobiling trip have been in Florida? It wouldn't have existed. So if you define your pleasantness over the ability to snowmobile, Wyoming's amazing if you ski, snowmobile, do these kind of winter-related sports. But I mean, the point is, you can certainly move to a low tax rate state, but you gotta actually move to the state, which means you're gonna leave behind your family, you have to be in a new place, and so it's kind of a mobility exercise. It's a pretty big deal. It's certainly something people do, but
do people actually really do it?
There is some evidence. I don't think it's like dramatic, but there is some evidence we do see tax-related mobility.
So people move to lower their tax bills.
Mobility, yeah.
Yeah, people move to lower their tax bills. So that's
and part of why it's hard to tell whether it's taxed or not is because, a lot of states have different amenities, right? So when you're older, Florida seems like a great place, but also it might be the weather, it might be because taxes, but it does seem that their taxes do seem to play a role.
Okay, so let's suppose I don't want to move. Let's suppose I'm happy in North Carolina and I don't want to move. And as you may know, because you were with me, I bought some options to purchase shares of a company called IonQ. And it's an up-and-coming quantum computing company, and I anticipate, and actually I bought some shares before I bought the options, and the shares have gone up quite a bit. And I'm tempted to sell because they've gone up, and I don't know if it's sustainable, okay? But if I sell now, I would have to pay capital gains. Actually, it would be even worse because I have not owned the stock for very long. I've only owned it for maybe a month. So
short-term capital gains.
That would be a short-term capital gain, which means I would have to pay tax at my highest ordinary rate, right? My personal tax rate.
It would be a higher rate, yep.
So what if I don't want to pay that much tax? What can I do?
It seems like you got two options. If you don't want to pay that much tax, you could just wait for a year. There's actually pretty good evidence, or not pretty good, there's kind of startlingly good evidence on that people really do focus on the long-term versus short-term capital gains. Again, like Scott said, if you hold for more than 365 days, then you get this long-term capital gains tax rate, which is smaller than the short-term capital gains tax rate. And people really do wait like 366 days to sell as opposed to 364. So one thing you could do is just wait for that lower rate. But then also, if you wanted to avoid the taxes altogether and never pay those taxes, you could just give all those shares to the UNC Tax Center.
Well, that might be problematic. Well, actually, I don't know. So I am a UNC alum, but I work at Duke, and I don't know if that would.
All that you need is the UNC Tax Center is a qualified charity, and
so I could donate my shares, not sell my shares and give the cash, but actually give the shares to a charitable organization.
Yep. And so then what you get there is the charity gets the shares, and we would sell them, and we would use those proceeds to the amazing things we do at the UNC Tax Center.
Like, for example, buy a little trinket for everyone who attends the UNC Tax Symposium.
That's like 1% of the cost of the symposium, but we could put on the symposium. Yep. So, but the advantage to you is you never have to pay those taxes, right? So let's say, I have no idea how much of this stock you bought. Let's say you have $20,000 worth of stock. You bought it for 10. That $10,000 that you would be paying capital gains tax goes completely untaxed if you donate to charity.
So I can feel good because I gave my $20,000 of stock to the UNC Tax Center. I would choose something different, but that's okay. We'll say the UNC Tax Center. And I would feel good and happy because UNC got my donation. And I would feel even better because I didn't have to pay, in this case, short-term capital gains. And I would never have to pay the capital gains.
Of course, there's of course a downside, just like the sinkholes, just like actually being dead. The downside.
Well, hang on, don't take my downside away yet. There's one more upside. If I itemize my taxes, I also get a deduction for charitable contribution. Correct?
And it's actually a pretty sweet deal. You get the charitable deduction at the fair market value. So again, if you bought it at 10, you give it away at 20, you get the deduction for the full 20, which is a pretty startlingly good deal, actually.
So UNC wins, I win, and Uncle Sam loses.
Well, no, Uncle Sam is made much better off because of the high quality research the UNC Tax Center will. You're subsidizing a public good, and that's exactly what the government intended, right? Uncle Sam doesn't lose; he just gets paid in a different way through high quality tax research.
Okay, good. So now you said there's a downside. I'm looking at some really big upsides. Now rain on my parade for me.
Okay, well, the downside, of course, is you actually have to give your shares away, right? So you're not going to be able to use that $20,000 to buy whatever else you would have bought. You have to give it away. And so people have in their mind that they like a donation to charity is just for tax purposes. That's ludicrous, right? You are $20,000 poorer than you would have been, even if you would have $20,000 poorer than you would have been, even if you would have kept the shares, paid taxes, you would have still had something other than that.
So I would have had 80% of that value, or
zero. You would have had 80% of that value. That's exactly right.
Roughly 80% or 75 or 80%.
And so why would that make sense? Well, it turns out some people, perhaps including you, do have some charitable motive. There are charities that you just give to every year. You're going to give some of your money away. And if you do that in the form of appreciated shares as opposed to cash, it's a pretty smart move that's pretty common to do. I mean, most large charities, in fact, they're pretty familiar with receiving these appreciated shares. You can call them up and say, I want to do this. They'll have a way to route your shares through your brokerage account. So it's a common thing to do and a really good move. It's good even if you don't itemize. It's amazingly good if you do itemize.
Okay, so that's something to think about. If you are listening to this and you have shares that have appreciated and you want to avoid paying capital gains taxes and you are going to donate to your favorite charitable organization anyway,
that last part's key.
Yeah, the anyway part is key, right?
Yeah.
But if you're going to do it anyway, then it is probably in your best interest to donate some appreciated shares as opposed to paying cash.
Correct.
Yeah. Okay, cool. All right. So that's another pretty interesting way to minimize your capital gains tax bill. Are there more things we could do?
Well, so we were just talking about your situation, which you bought these shares and they went up crazy in value. Maybe instead we should talk about tax planning that I could do. Of course, when I buy shares, they don't go up. They go down.
So actually, if anybody wants a good stock trading strategy, what you do is you short whatever Jeff goes long in.
Portfolio, short my long portfolio. That's exactly right. So, there's a very common strategy called tax loss harvesting. And the idea here is if you have shares that went down in value, you sell them, because those capital losses are deductible against other capital gains, and to some extent they're deductible against ordinary income. So let's put this in real terms. So Scott bought at 10 and went up to 20. Let's say I bought at 20 and am now down to 10. If I sell those shares, I have $10,000 of capital losses that I can use to offset either other places in my portfolio where I've had gains, or to offset up to $3,000 of ordinary income.
Okay, but hold on just a minute. Your losses can't offset my gains. So you ideally need to have your own gains.
Yeah, I do have some gains. I mean, I gain every once in a while.
Okay, so the way tax loss harvesting works then is if I look at my portfolio and I have some things in my portfolio that have gone up and I'm going to have to pay tax, and I have some things in my portfolio that have gone down, I might be able to sell the things that have gone up and sell some of the things that have gone down and use the losses to offset the gains. But now I have a conundrum, which is I maybe sold some of these things that had lost and maybe I didn't want to sell them. Maybe I wanted to hold them. So what can I do?
So that's actually quite an interesting philosophical question. So, when I talk about this with other people, I say, what's the downside of this? I say, oh, you have to sell your shares. You don't hold them anymore. And so it comes back to what's your expectation for the price of a share that you hold? And it goes to back this kind of deep philosophical question for how rational is the market? If you believe in markets that impound all the information that's out there and you don't have any private information, your expectation for price movements over the future is pretty much flat. So it doesn't matter if you sold them.
But what if I really, really want it? Why can't I just sell my lost shares today?
Why would you really want it?
Because I think it's going to go up. But let's just
if you think it's going to go up, you should be mortgaging your house, taking out credit cards. The fact is, Scott, even though you think that everything's going to go to 10 to 20, you don't know that it's going to go up.
Thank you, Mr. Fama. Mr. Efficient Markets, for those of you who don't know.
This is pretty important, but let's just stop arguing about this. Let's assume this is shares in Scott's turkey farm, and so he has insider information that isn't reflected in the market. Somehow he does know that the shares are going to go up. Then what?
Well, could be. Here's what I'm saying. What I'm saying is I want to hold the shares for whatever reason.
I'm saying that desire itself is irrational. But let's say you do want it because you know it's going up because it's turkey farm. Yep.
Okay, so I have some insider information, so my desire is rational. But I want to sell to save taxes. Why can't I sell today and then just buy again tomorrow?
So you can't do that. because we have this thing called the wash sale rule, where if you sell a stock, especially at a loss, and then you buy it back within 30 days, the IRS basically pretends that didn't happen and you don't get to take advantage of that loss. So you got to stay out of the market for 30 days.
So with tax loss harvesting, I can sell my losses, sell my things, my assets that have losses, and use those losses to offset my gains. But one of the consequences of that is I cannot then repurchase substantially similar assets within 30 days. Otherwise, I will run afoul of what are called the wash sale rules, and the loss will not be usable to offset my gains.
Yep. And what's actually fascinating about tax loss harvesting is there's, certainly there's whole portfolios that do this. This is like a little cottage industry to help people tax loss harvest. But the actual gains from doing so, and there's a lot of academic papers that try to estimate the gains from tax loss harvesting, and it's actually pretty tricky because you have to make some assumption about what you do with the money when you sell. And of course, the easiest assumption is just to say, oh, you just buy the identical asset back. And you'll usually you'll find a footnote of these papers that say, we just assume that the wash sale rule doesn't happen. So what you do with that cash actually really matters for what you get as far as like returns from tax loss harvesting. So I actually, last week, I tax loss harvested myself. It's coming towards the end of the year. I put on my like little farmer's hat and I went out and looked at my portfolio, looked to see the assets that were down. I sold them, but it wasn't like any of these papers assume. Why? Because that cash is actually just still sitting in my portfolio. To do this, to get the gains that are hypothesized, you have to do something with that cash. And usually we assume we just put them right back in the same assets, which you can't legally do.
So that's an interesting thing to point out. What people often think about is, I want to minimize my taxes. But that's not actually what you want to do. What you really want to do is you want to maximize your after-tax return. And if in an effort to minimize your taxes, you end up leaving some profits on the table because your assets now sit in cash and don't earn any profits while the market goes up and up and up like it has been doing, you may have ended up losing overall value even though you saved yourself some taxes, which would be, of course, a bad idea.
Yeah, that's exactly right. Which is basically like all of my personal financial planning. It's a bad idea. Don't do what I do.
Don't do what Jeff does. That's an easy strategy. Instead, just plan on inheriting a whole bunch of turkey farm money, and then you don't have to worry about it.
Correct.
Okay, great. So there are also these things that you've done some research on, which can help one reduce their capital gains tax burden. These unusual little things which were created, I think, in the 2017 tax reform, called opportunity zones. What are those, and how might they help someone reduce their capital gains tax bill?
What's pretty interesting about these is they are definitely used to reduce capital gains tax bills, but they're really they're not for everyone. I mean, how they work is essentially if you have appreciated assets, you can take those assets and use those funds to buy some kind of investment that is held in a geographic region called an opportunity zone. So these are census tracts that were designated by governors that have this benefit that basically it's designated as an opportunity zone. And the benefit is if you hold those investments in that zone for long enough, then you don't have to pay capital gains taxes on the proceeds.
And so the types of things, you wouldn't obviously be able to buy shares in a publicly traded company, but you might be able to buy real estate, or you might be able to buy some kind of small business that's located in one of these opportunity zones.
Real estate is where a lot of this is happening. But
Real estate mostly.
the problem here is you have to have all these appreciated assets. And so if you didn't start out with like some kind of capital gain that was appreciated a lot, that's enough to buy a whole building, it really isn't available to you. So this is a tax break that was allowed in the 2017 Tax Cuts and Jobs Act that's mostly available to the wealthy. But what's kind of surprising is there was a lot of Democrats that historically were in favor of this, and the reason why is because where the investment is going to happen. So the idea is you're going to take rich people's money, these appreciated shares, give them a tax break, and they're going to invest in these opportunity zones. And the idea is the opportunity zones were in these low-income, kind of impoverished type of areas, so that we'd see more investment in places that have a lot of poverty. So it's the rich people win, the poor people win, so everybody's happy.
So that sounds like an amazing idea, but my suspicion is, as with every tax, and every plan like that, it didn't work out exactly as planned. So were there some little kind of kinks?
I would say it depends on who you ask. I'd say a lot of people are quite happy with this, especially the people that are saving a lot in taxes. So there's been a lot of question about how these tracks were actually picked. So for example, I have a paper that basically suggests if you were a governor, you selected tracks that were more likely to be politically aligned with you.
So the population in that tract was more likely to be affiliated with the party of the governor.
More likely to have voted for your party as the governor. And so that's a good thing, or whether that's a good thing or a bad thing, I'm not sure, but there's certainly going to be some political bias when you allow governors to pick the areas that get these tax breaks. Now, there were like these strong requirements imposed by the Treasury of what areas the governors could pick. So, so then it comes to the question, do I really care if it's politically biased as long as it was poor? And they were all pretty much poor. I mean, there were some exceptions to that in the law, but they were all pretty much poor. So, there's might have been some political bias. And then, of course, the real question is it actually spurring more investment? Well, there's actually papers that go either way on this. My personal take is probably too early to tell, right? You're going to see these investments come over the long term. Whether you actually see additional investment that wouldn't have happened in those areas or that wouldn't have happened at all, I guess I would say is still kind of an outstanding question.
And so to be clear, if I had my amazing stock that has gone up substantially that I would have had to have paid capital gains on, I could have taken that stock, essentially sold it, and used the proceeds to invest in an opportunity zone. By doing so, I don't have to pay the capital gains tax now. And my understanding is if I leave those proceeds invested in the opportunity zone, is it 10 years?
I think it's 10 years. Yeah,
10 years, but long enough, then the capital gains tax that I would have paid goes away entirely. Is that correct?
Yes. And so, of course, like with everything, the sinkholes and dying and everything else, there's a downside, right? The downside is 10 years is quite a while, right? So you have that liquidity problem. But then also you have to invest in the opportunity zone. And so the question is you can invest in a non-opportunity zone for some rate of return. How much lower could the rate of return be in the opportunity zone to compensate you for having a lower tax rate, a zero capital gains tax rate? And there's, you could certainly work out that math. But there's downsides to these opportunity zones.
That's always the conundrum. Would I be better off with real estate in a certain zip code, or it's not really a zip code, but it's close to a zip code, the census tract that is sort of economically depressed? Would I be better off putting my money there, or would I be better off leaving it in my quantum computing company, which I believe will soon have the next $1 trillion valuation?
Or selling it and putting it in a opportunity zone census tract. And if the return there is high enough, you might be better off doing that.
Exactly. And then there's of course always the conundrum that once people start investing in opportunity zone, these census tracts that are opportunity zones, do the assets in those zones, does the price of those assets get bid up beyond what it otherwise would have been? And so who reaps the benefits of these tax savings? And that's another question that researchers will investigate.
If you have opportunity zone, house prices and apartment prices and real estate prices might just go up so high that it erodes the complete value of the tax break. And my guess is we're certainly going to see some concrete evidence on whether that happened. And there actually already is a little bit of evidence regarding that.
Okay, so we've covered a lot of ground, so let me just try to briefly summarize. If I have an appreciated asset in which I have a lot of capital gains and I don't want to pay any or as much capital gains tax, there are several things I could do. One is I could wait until the tax becomes lower by holding, say, till it becomes long-term capital gains instead of short-term capital gains. I could potentially sell now if a new tax is coming. That's what the CEO of Microsoft did, Satya Nadella.
Allegedly.
Well, he did sell. Whether he did it for tax purposes, we don't know. Allegedly for tax purposes. I could hold my shares until I die, but the downside is I will be dead. I could move.
Downside for you. There might be people quite happy about that, actually.
That's true. There might be a lot of people happy about that. But in any case, my downside would be I would be dead. I could move to Texas or Florida or Jeff's favorite, Wyoming. If I were moving to Wyoming, I would live in northwestern Wyoming. Jeff would probably live in eastern Wyoming, but we could debate that. Why Wyoming or Florida? Because the tax rates are very
Capital
low,
gains tax rate is zero.
Or zero. In Wyoming, it's zero. I could donate to charity, donate my shares to charity, which has the big upside of tax savings, but the downside is you don't own the shares anymore. You have to give them away. And if you were going to give something to the charity anyway, then that might be a really big plus. And the last thing we talked about were opportunity zones, which are complicated but very fascinating. Did we miss anything big, Jeff?
I think that's about it.
Yeah, lots of ways that one can reduce the capital gains tax burden. We'll certainly end up talking about these issues repeatedly, but there's many fascinating ways to avoid any tax, and with capital gains, lots of possibilities. I think we've come up on our 30 minutes. It's been great chatting with you. We'll chat with you next time. Goodbye.
Goodbye.